All right, welcome everyone. Today, we're going to dive into a concept that's absolutely fundamental to every single financial decision you'll make in your careers. We're talking about uncovering the true cost of money. And let me be clear, this isn't just about crunching numbers. It's about developing the sharp, analytical mindset you need to make smart, profitable business decisions. So let's kick things off with a very practical scenario, something you will absolutely face out there in the business world. Imagine your company needs some capital for a big new project. You've got two loan offers on your desk, and both are advertising a 6% interest rate. Now, on the surface, they look identical, right? Your first instinct might be, they're the same. But this right here is where a truly great financial manager separates themselves from an average one. It's all about looking past what's on the surface.
To really get to the bottom of this, we have to look past that sticker price. We have to understand the critical, and I mean critical difference between the nominal rate, that's the advertised number, and the effective rate, which is what you actually pay over a year. Think of the nominal rate as a marketing number. It's designed to grab your attention, but it's the effective rate that hits your company's bottom line.
You know, relying only on that stated nominal rate is one of the biggest and honestly one of the most common mistakes that future business leaders can make. It's an illusion, really, because it leaves out a key piece of the puzzle. So let's peel back that layer and see what's really going on behind the scenes.
So what exactly is the nominal interest rate? In formal terms, well, it's the baseline. It's the simple annual rate a lender quotes you. You can think of it as the rate in a world where interest is only calculated once per year. But as we all know, the real financial world is a lot more active than that.
And this is where it gets really interesting. There's this powerful, often invisible force that completely changes this baseline cost. It's a hidden engine, humming away in the background of pretty much every loan and investment, and it has the power to totally change the final outcome. This engine is exactly why nominal rates can be so misleading.
And that hidden engine? It's called compounding. This is the whole reason we need to calculate an effective rate. Compounding is simply the process of interest earning interest. For long, that means you're being charged interest not just on your original loan amount, but on the interest that's already built up. It creates a snowball effect on the total amount you owe.
Now, the crucial thing to get here is that every time interest compounds, the base amount, the principal, gets bigger. This creates an accelerating effect. If it's a loan, your debt grows faster and faster. If it's an investment, fantastic. Your wealth grows faster and faster. It's a perfect example of the time value of money in action.
So this leads us to the big question for any analyst. If that nominal rate doesn't tell the whole story, how can we accurately measure and compare different loans or investments? Well, the answer is to use a standard tool, a formula that takes that nominal rate and the compounding frequency and translates them into one single, clear, comparable number, the true annual rate.
So let's do that. Let's move on and actually deconstruct the formula for the effective annual rate, or EAR. And I want to be clear, it's not enough to just memorize this formula. Understanding the logic behind it is what's going to give you the power to make sharp, strategic financial decisions for the rest of your career.
Okay, here it is. And I know at first glance, a formula like this can look a little intense, but I want you to think of it not just as an equation, but as a truth calculator. It's a tool for standardization. Every single part of this has a specific job to do in converting that shiny advertised rate into the real cost of borrowing. So let's break it down piece by piece.
First up, we've got the variable I. This is just our nominal rate, so in our example, it's 6%. Now this is absolutely critical, and it's a very common mistake students make. For the calculation, you must express this rate as a decimal. So 6% becomes 0.06. Forgetting that conversion will give you a completely wrong answer. This is our raw data, our starting point.
Next, we have N. I like to think of N as the compounding engine itself, or maybe how fast it's running. It's the number of times per year that interest is calculated and tacked onto the principal. So if interest is compounded monthly, N is 12. If it's quarterly, N is 4. If it were daily, N would be 365. The higher N is, the more often that engine runs, and the bigger the impact of compounding will be.
And when you look at it this way, the logic of the formula is actually pretty elegant. First, you see, we divide I by N. That just gives us the little slice of interest for one single period. Then, the 1 plus I over N nth part takes that small periodic rate and compounds it for all the periods in the year. The 1 in there represents our original principal, so when we subtract it out at the end, we're left with just the interest part, which is our effective annual rate.
Okay, theory time is over.
Let's apply this formula to our two 6% loan offers. It's time to put on your financial manager hat. We're going to use this tool to protect the company's money and make the best possible choice. This is exactly the mindset you have to have. Your job is to be skeptical, to question the surface-level numbers. As a financial manager, your reaction should immediately be, hold on a second. Let me run the EAR for both of these before we sign anything. That's what we call due diligence.
All right, let's analyze loan A first. The nominal rate, I, is 0.06. The interest is compounded monthly, so our N is 12. So we just plug those numbers right into our formula. We've got EAR equals, in parentheses, 1 plus 0.06 divided by 12, all raised to the 12th power, and then minus 1. And after you run that calculation, what do you find? The true cost of this loan isn't 6% at all. It's actually about 6.17%. Now, that difference of 0.17% might sound tiny, but that represents a real, tangible cost to your company that's going to have a direct impact on your profits.
Now let's look at loan B. The nominal rate is the same, 0.06. But the key difference here is that the interest is compounded quarterly. So in this case, our N is 4. The calculation becomes EAR equals, parentheses, 1 plus 0.06 divided by 4, all raised to the 4th power, minus 1.
And the effective rate for this loan? It comes out to approximately 6.136%. So notice what happened. It's still higher than the 6% nominal rate, but it is slightly lower than the 6.17% from the monthly option. And that difference is purely because of N, the compounding engine, is running less frequently.
And when you put the true costs side by side like this, the decision becomes crystal clear. Yeah, both loans are more expensive than they look, but loan B, with its less frequent compounding, is without a doubt the cheaper option. And to put that into perspective, on a $10 million loan, that seemingly tiny difference could save your company thousands of dollars in interest in the first year alone. That's the real-world impact of the decisions you'll be making.
Look, this entire exercise has been about way more than just one formula. It's about truly mastering a core financial concept so that you can avoid a very common and potentially very expensive mistake. And it's a mistake that trips up not just students, but even experienced professionals who let their guard down.
So, the number one takeaway, the most important thing I want you to walk away with today is this: never, and I mean never, accept a nominal rate at face value. Your first instinct as a financial professional should always be to ask, okay, what's the compounding frequency? And then immediately calculate the EAR. It is the only way to make a true, fair, apples-to-apples comparison.
And I'll leave you with one final thought to chew on. We've spent this whole session talking about compounding as a cost, as this force that makes debt more expensive, but remember, this powerful engine is neutral. It's a tool. It can work against you with debt, but it can also work for you with investments. So the question becomes, how can you harness this very same principle to build wealth for your company or for yourself? And that is a topic for our next discussion.